When you look at those two together, I guess the sum of the parts are certainly worth more than 20, 25 million market cap, even in this environment.
And what can you do? What can you actually affect or control? What did you tell them you were going to do with the cash? Was it a case of, oh, it'll pay my salary for the next 2 years while we wait for the market to turn? Or do they have expectations of you to enhance the value of the, what are not insignificant assets that you've got? Welcome to Crux Investor. Thank you so much for watching this video. If you like it, give us a thumbs up and do leave your comments below. It just helps us understand the types of questions you'd like us to ask, how we're doing, and indeed what you think of the company. If you haven't already done so, please click the button in the corner of the screen to subscribe to our YouTube channel. And of course, for more videos like this, click the notification bell. We spoke earlier today to Alex Holmes, who's the CEO of Plateau Energy Metals. Now, they're a TSX-listed company with two assets in Peru. One uranium, the other in lithium. Pretty difficult commodities of late. We talked to Alex about the difficulties of delivering some kind of value for shareholders with not a lot of cash. Obviously, uranium's seen a bit of an uptick in interest following the moves in the market recently because of shortages of supply. And we talked to Alex about the lithium project, which is quite significant, reasonably large project. But again, how do you move those forwards without too much money? So take a look at some of his answers and some of the topics we discuss in the description below. Anything interests you in particular, click on that timestamp and I'll take you to that part of the video. So let's hear what Alex had to say. Hey Alex, how you doing, sir?
Good day to you. Well, thank you. How are you?
Good day to you. That's very formal. Good day to you as well.
Yes.
You're at home, Vancouver Island, having a nice time. We haven't spoken for a while. How are things? How are you?
Well, managing.
Yeah.
Certainly, pandemic has created its own challenges for all of us.
Yeah.
But I think we're navigating through this as a family, and we've got a company as well to think about.
Yeah. Well, that's what we're going to talk about today. So let's do the usual kick-off 1 minute overview for people new to this, and I'll take it from there.
Sure, absolutely. So Plateau Energy Metals, listed on the TSX Venture Exchange under PLU ticker symbol, operating in Peru for approximately 15 years. We have two projects. One is a lithium project that's sort of newer to the portfolio after discovery in 2017. In 2 years, we've completed extensive metallurgical engineering work to take it to a first economic study, and that was put out in the beginning of February. And then we have our uranium project, which is also development stage, that was actually the founding basis of the company, but through consolidation and exploration, expanded it to over 120 million pounds of resource. And the last study on that was 2016. Largely been on care and maintenance since then, just as a result of the market.
Right. Okay. So I think when last time we talked, I talked about those are quite two very tricky commodities at the moment. Lithium a little bit unloved, uranium definitely unloved, but things have changed. Not least of all your presentation, because I think you've seen a bit of movement in the uranium space of the last month or so, and you're talking a green energy story there. You've kind of brought uranium back into the fold. So why don't we talk about that first? So the market's moved. You've seen the spot price go up. The sentiment has changed. We talked about sentiment last time as well. Is that in your thinking when you're bringing this up? Because I think one of the topics we discussed was potential split of the company where you take the lithium off one way and uranium another. So what's been in the thinking of the board and yourself on the uranium?
We did put uranium project just to the bit of the background in terms of the way we were communicating ourselves. We've always looked at presenting ourselves as a green energy company, if you will. The reason we put it to the background was largely sentiment. And we have seen that shifted recently with shutdowns. We've seen the spot price move. I think I'd still like to see some term contracts and utilities covering to really say this is more than just a pandemic move. The other thing we were waiting on was the regulations from the government for export and transport. And recently in March at the PDAC, the Vice Minister of Energy and Mines announced publicly that they're working on those. They will be in place by the end of this year. And while Peru's on shutdown as well, we've been able to speak to the ministry and just confirm that those are still on track. So I think those are two things that help us show to investors, look, this is a uranium project with a large resource base. It's low capex, low opex, has a lot of merits going for it, and it's time for us to revisit this and start to bring it more into the limelight, so to speak.
Right. I guess as the market evolves, like I say, there's been a lot, which we've discussed with a lot of uranium junior CEOs over the past months or so, a lot of movement in that space. Like I say, spot price coming back, a lot of shutdowns, Sakara Lake and the Kazatomprom and Namibia, etc. It's all building for the macro story. And you do have a large-ish resource, but you've also got a lot of hair on it. What type of company or strategic partner do you think is going to be interested in stepping in and grappling with some of the issues that you've been grappling with over the past couple of years?
Well, I think that one of those hairs is our concessions issue that we're working through. I think, indicative of the government's support to see this project move forward is two-part. One is the desire to put regulations in place. The other piece is breaking up and fragmenting portions of the uranium deposits, because it's a series of deposits, simply is not logical. And so I think that those two in many ways go hand in hand. And so I think we'll resolve that hair in time. And we've always thought that, but it takes time, right? We're working in South America. With regards to, when I look at the other hair, if you will, I think that, that it's the regulations. So I think those are coming. I think that'll be a huge statement of the government's desire to see these move forward. Uranium development in Peru is generally as a whole. I think people are very comfortable with Peru as a mining jurisdiction. It has a relatively stable currency. There's a lot of foreign investment there, etc. And so in terms of the strategic parties, I think interested, because it's north of the 100 million pound, we'll call it a threshold, it really is appealing from a mine life production profile perspective. And when you chalk it up against other projects in and around this resource size, you've also got low capital intensity and low operating costs. And we see areas where we would like to spend a little bit of money this year to potentially, that would ultimately have the impact of improving the economics.
Right. So what do you remind people what you know about it today? Because you talk about low cost, good economics. What does that mean?
So 2016 was the last PEA study that was completed. And it was done at $50 a pound, which was pretty normal for that period of time for where people were pricing studies. We have a 300 million initial capex, 10-year mine life, 6 million pounds a year, 17 and change cash cost, 18 and change all-in sustaining cost. It's a 40% IRR after tax, 1.8 year payback. That's only 70 million pounds of the 124 million pounds in resource. And a large driver of that is it was obviously grade related in terms of what makes its way into the mine plan. The piece of work I alluded to is pre-concentration work. So Cameco in 2013, if you recall, they used to own some of these concessions, and it had a resource of about 30 million pounds in those concessions. And they had done work in 2013, and they demonstrated that about 85% of the uranium sits in half of the rock. And they believed that traditional pre-concentration methodologies could separate, and effectively the result would be we could relook at the 50 or so million pounds not in the mine plan as potentially coming into the mine plan, and also look at, we would be looking at effectively processing higher grade or less material, however you want to look at it. Okay. And that could have an impact overall on the project economics.
So how much money are we talking about spending for you to be able to get to the point where you go, okay, I think we've got the additional information you're going to need to support that 2016 PEA to be able to then go and have conversations with a group and say, look, I think this is workable, because the numbers from the PEA look great, right? But it's a PEA. You know, do you take it through the PFS, or do you give it to someone else to do? What's going on in your head? How do you think you monetize this?
Well, we actually think there's a path to feasibility study. The biggest portion of what's left to be done on the step towards feasibility study is infill drilling to reserves. There's been a lot of processing work done in the background over the years. Remember, it was 10 years of metallurgical test work ahead of this, and a couple 100,000 meters of drilling. So the path to feasibility study is approximately 18 months and $20 million US. And that includes concurrently doing the environmental permitting process. I don't think we need to take it all the way to feasibility study to attract a strategic partner. What I believe we need is that strategic partner to see the asset for what it is today, see the opportunities that we've already identified that need some test work to be able to validate them, and then get involved to help be part of that funding solution towards feasibility study.
Okay, so it seems to me there's two routes. So there's some money you want to spend this year. How much money have you got in the bank at the moment?
When we close our second tranche of our financing, we'll have approximately $2.4 million cash net.
Right, so how much of that are you proposing you spend on the uranium asset?
So the pre-concentration work is under $100,000.
Right, okay.
It's approximately $50,000. It's not a huge Canadian. It's not a huge amount of test work to be done. Pending the outcome of that work, if it's positive, I think the decision we need to make is, does it make sense to do effectively an update on the PEA, just to kind of recast the project as this is what we'll be focusing on towards feasibility, and then look at bringing in a party to work with us to move it forward.
Right, so just to understand what the options are. So you'll spend $100,000 plus I don't know what amount to be able to make a decision as to whether you're going to take it through the PFS stage. So you talked about $20 million being able to get it through to the end of a PFS with more drilling, etc. Your market cap's like 23 million today. So what point do you bring in the strategic, before or after the PFS? Because obviously that's going to be dilatory.
It's approximately 20 million to feasibility.
To feasibility,
right. Beforehand, we would like a strategic partner to be part of the solution that takes it to feasibility study.
Got it. Okay. So
or all of the solution.
Okay, so there's a bit of work before you can have those conversations, but not a lot of money needs to be spent to get to a point where you're having those conversations. Okay.
I think we can. The project status is such that we can have those conversations sooner rather than later, and on the back of that, seeing the regulations get in place from Ministry of Energy and Mines. I do think that when you look around the world, there's a handful of projects that kind of fit within, our large scale, long mine life, exploration upside, reasonable capex relative to production profile, and it's the audience that is looking at that to have exposure to that we'll be having conversations with.
Okay, well let's see what happens. The market seems to be fast changing at the moment. And if that keeps going the way it is, I guess you're going to have more conversations than less. Let's bounce over to the lithium project, because that's where you see the company's success being. It's a very large project. In fact, why don't you break down the project for us?
Sure. So in terms of resource, it's 4.7 million tons lithium carbonate equivalent, hard rock deposit. We have a 33-year mine life with a phased expansion plan. So an initial capex of just under 600 million, phased expansion of 3 phases throughout the mine life of 33 years. Low operating cost, it's low second quartile, just under $4,000 per ton. And this excludes any potential byproducts. It excludes excess power that gets generated at site. And this focuses on the lithium-rich tuff. There's effectively 3 zones of mineralization. The tuff is the higher grade zone that's sandwiched top and bottom by the other zones, and that's about 50% of the resource. The lower and upper zones are lower grade in lithium, higher grade in things like cesium, rubidium, and potassium. So they almost need a different line of thinking in the future. And the project itself is able to, through a conventional tank leaching approach that's used in copper and gold industry, extracts lithium into sulfate solution, And downstream of there, we go through a standard impurity removal, 3 steps to crystallizer precipitation plant and precipitate out a lithium chemical. In this case, we've demonstrated a path to lithium carbonate. However, because we start in lithium sulfate solution, we will be looking to demonstrate the project flexibility to hydroxide, even a sulfate salt, as an example.
Right. So how are you viewing the market at the moment? Because last time we spoke, you seemed to think this is a very reasonably priced CapEx. I noticed you've reduced it a bit, have you? Has CapEx dropped a bit? No?
No, it's just under 600.
Just under 600. Okay.
And then the phased expansions are funded from cash flows.
Probably what I was remembering. Okay. We've talked to a few lithium players in the market, and the DFS stage, they're looking to get financed. They're struggling, not just COVID, but pre-COVID. The lithium space is saturated. What's the play here for you? Because you got 2.3 million. You're going to spend a couple of $100,000 of that on advancing the uranium through to uranium assets. You can have a conversation there, but what's the plan here? Is it just survival mode until the market recovers? And what can you do? What can you actually affect or control?
I think we can't control the pace of EV adoption, for example. We can't control the pace of gigafactories being built and the requirement for the raw materials. So what we can control within our destiny, if you will, is I think this year is really about being carefully managing capital to move through it's an unprecedented time. And see how the second half of the year starts to play out as economies slowly start to open up again. The lithium space is a challenge right now. There's no doubts about it. It's been that way arguably for a couple of years, really. It's been this downward trend. With the economic setback, people start to wonder how quickly are consumers going to get back out there and start buying cars. So certainly, that's a cyclical industry. And having said all that, I have noticed that the car companies in Europe continue to stay committed to their EV rollout. VW being the biggest with their ID3. For all I know, they could start giving those away. I don't know, just to get to their emission regulation caps. And then there's been open letters sent in by large industries in Europe saying, don't change the emissions cap, let's stay on course here. We need to focus on this. And just because we're going through what we're going through doesn't mean we should give up on the green economy and reducing our footprint and impact on the world. So I think that's the demand side. And on the supply side, you mentioned that you've spoken to a few lithium companies as well. I don't see projects moving forward in this environment. There's no project finance coming. The projects that have been stalled, put on care and maintenance, come offline. Some of that's driven by maybe they shouldn't have been built in the first place, and because where prices have gone to. Some of that's also driven by, just a lack of new capital coming into the system to be able to support these. So I think that we shouldn't lose focus on the supply side. It's still not going to be able to keep up. And that's been a theme. And we've had this excess supply the last 2 years, excess supply this year. Arguably, the pipeline of development projects that were planned or positioned to come on stream over the next 5 years that landscape's changed and moved around a bit.
Yeah, I mean, we again spoken to some CEOs of some other battery metal companies as well. One this morning from Australia, and he was painting a devastating picture of the effect of COVID-19 in terms of disrupting supply chains, production in China, across Asia, and to a greater extent in the US as well. So, but we also discussed that's what's actually happening right now, and in his view on how quickly that gets back up and running with this kind of disconnected chain gets up and running again wasn't good. But that's his opinion. But he's operated in that space for a long time. I'm wondering what the buying behavioral pattern of regular people is. If you were going to buy a car, and you may have been switching to a BMW electric car, do you hold off for a couple of years? And what do those decisions mean? So that's got to weigh heavily on your mind about how the buyers, whatever targets you set, whatever people think of the green revolution, if people don't spend money to buy these cars, there's nothing the automotives can do about it other than wait, which is the position you're in, isn't it?
I think that we can't predict consumer behavior, but we do know from the past history that when people are out of work, or they've had salary cutbacks, or they feel like we're heading into a recession, the spending slows down and savings increase. I don't think people's mindsets have changed in the willingness to get into electric vehicles. So even though oil is where it is, I don't really think that that's going to have a long-term impact, because while that's all happening, the cost of batteries continues to come down, and the efficiencies and the technology, and we're managing to get to a point where the life cost, total cost of ownership of an electric vehicle still makes more sense than a petrol vehicle. So I think that the car companies, this is complete speculation, to be honest, but I believe that as we come through this, I think that subsidies, low-cost financing, there's going to be a number of attractive options that are going to be enticing for people to pull out their pocketbooks and really look at electric vehicles as their next purchase for a vehicle. I think that we have to remember it's only a 2 million a year vehicle market in total, compared to a 100 million vehicle market globally for all consumer passenger vehicles, internal combustion, everything. So it's really a small piece of the pie today. So anyways, that's kind of my general thinking about it. I think that what the pandemic has done for the world is it's probably opened our eyes up to the risk, or the exposure our supply chains have to relying too heavily on one partner or one supplier. And I think that could cause an interesting shift in the way certainly OEMs think about their supply chains. They can't have exposure to one country so heavily. And so they'll start to look at other ways to protect their supply chain as they, whether it's more slowly or continue at this pace, start to roll out electric vehicle models.
That's enough forecasting from us. I think we should come back to you. So you've got about $2 million left. So the original question was, do you hunker down, go into survival mode, or are you going to spend that $2 million? And if so, what on?
It's very much survival mode.
Right.
Small programs. The uranium pre-concentration program is small, dollar-wise, but hunker down. To be honest, I don't think it's going to get worse before it gets better.
Right.
I think realities will start to set in, and I think 2021 is not off the table as a year for things to get to bounce back in some form. We've had rescue stimulus. Now let's see what happens when we come through this out the other end. But definitely hunkering down, being smart about where we spend our capital.
Okay. So on what basis did you do your recent raise? What did you tell them you were going to do with the cash? Was it a case of, it'll pay my salary for the next 2 years while we wait for the market to turn? Or do they have expectations of you to enhance the value of the or not insignificant assets that you've got?
Yeah, what we communicated was that preserve the assets base, right? So good standing fees, etc. So preserve the asset base in place. At the corporate level, we've cut costs where we can. We've gone to 75% of salaries where we can. So we are saving cash that way. We keep our Peru team intact, the core of the Peru team intact. So, assets, the Peru team is an asset, so I include that. Keep everybody together. And to the extent we can do work on the project, it'll be low-level work, preparatory things for being able to move the project forwards when markets are more positive and capital flows a little bit more readily, etc.
Right. So is there any good news on the lithium? Have you found stuff, discovered stuff, worked stuff out which people should be excited about or points to future success?
I think the work that the results we put on our preliminary network on our byproducts, I think are very positive. We have to bear in mind it's preliminary, but what ANSTO was able to show is that through temperature reduction, recall that we do an acid leach at 95 Celsius, as they reduce the temperature and neutralize the solution with lime, a neutralizing agent, they were able to drop out 100% of the cesium rubidium and about 18% of the potassium. The potassium coming, it's already in a sulfate solution, coming as an SOP. SOP is a fertilizer. I think the other thing this pandemic has done is really open our eyes up to how much we rely on farmers and agriculture. SOP is strategically important in Peru because it has no domestic sources, and the imports in Peru have been growing at 18% a year the last 10 years. So agriculture is a huge part of the economy. Cesium, rubidium are interesting small markets. Cesium is a very strategic chemical with a variety of uses. It can be high value. I think the important thing is it came readily out of solution. Now we need to understand what's the value impact of that. Okay. But all of those things we believe are going to be contributors to improving the economics of the project.
Okay, and just to explain the MOU to me for the SOP. I mean, what was the structure of that again, or what was the point of it?
So I really look at it as a first step of what we hope will be a much longer term relationship, working with a family-owned company that's certainly one of the larger fertilizer traders, marketers, producers. What we're hoping this evolves into, and the intention it evolves into, is an offtake for the SOP.
Got it. Okay.
We obviously have our development work to do. What was really attractive about Amaropa is their long-term relationship value. They've got inroads into the farmers, into the end user, that's going to make sure the product that we produce is appealing as possible to them.
Yeah, okay.
And so they bring some know-how to the table, and we bring some know-how to the table.
Okay. What would you say shareholders need to be thinking about? Because obviously lithium's in a difficult space. Uranium's has been in a difficult space for a long time. But what's your message to your shareholders or people looking at this from new?
I think, sort of pull it all together, what investors should keep in mind is, yes, the lithium market is challenging at the moment. The long-term outlook has not changed. We have a very large asset with attractive economics, $1.5 billion NPV done at the same price deck as basically other lithium companies. That's very strategic. We're in a strong jurisdiction of Peru. And the second asset, which, really should really get as much attention as the lithium asset as our uranium asset. It's a large resource base. It's low capex, low cost, operating cost, all-in sustaining cost. That NPV after tax is $600 million, done at $50 per pound in 2016. At $35 a pound, it's still $230 million NPV. So, and mid-20s IRR. So, when you look at those two together, I guess the sum of the parts are certainly worth more than 25 million market cap, even in this environment. And as a group, we've been able to pull that uranium project together, move it through development. Yes, hit pause because of sentiment. We're looking to kind of restart that on a slow basis, find ways to incrementally improve it. And in 2 years, we went from a discovery of a lithium deposit to a very large project that is, I think, strategically important in the supply chain. And the two together are a very attractive portfolio.
Alex, thanks very much for the update. I know it's like the market is crazy at the moment. Obviously, lithium, I think you say it's probably a waiting game, not just for your project, but for lots of lithium projects at the moment, whatever stage they're at. But the uranium sounds like it could be moving. Your project could be the missing piece for someone. So look forward to. Why don't you let us know how that work does? That work that you're doing there goes, and do keep us up to date. Pick up the phone, tell us what's going on.
Okay, very good. Thank you.